CNBC contributor Peter Boockvar joins us now. He's the chief investment officer at Bleakley Advisory Group. Peter, great to have you with us. You think this Fed path that it's laid out is going to cause market pain? Why? How?
Well, I think it's just a very difficult thing that they're trying to pull off. I mean, what we heard today is what their plan is, and via their forecast, what their hope is, how the economy sort of absorbs this. I mean, the assumption that the Fed is going to raise this year to almost 2%, raise next year to 3%, and there'll be very little economic repercussions or very little impact to markets, I think is highly misplaced. And look within the Fed's projections. They think that the unemployment rate through taking the Fed funds rate from 0 to 3 is going to magically stay at 3.5%. And the reason why I'm worried about this is because, and something I've talked about for a while, is that you can't separate out the cost of capital, the direction of the economy, and the direction of markets. Because we have credit cycles that ebb and flow with the cost of capital. The cost of capital is now going higher, so there's going to be a negative economic reaction to that. There's going to be a negative multiple reaction in markets. And I don't know how we can sort of skate through this cleanly as Powell hopes we can do.
Peter, it's Tim. Look, I share your skepticism on equity markets. Significant skepticism, I think, is warranted. But help the confused here, as we all profess to be. How does the dollar give up 70 basis points off of those intraday highs? How does the 10-year, which went up to 225 intraday, go all the way back down to 219? Short end of the curve gives something up. What was dovish in the interpretation here? Because it was hawkish.
There was not. It was hawkish, and that's why the 2-year went up 9 basis points. What the bond market said to you is, yeah, he's going to raise, or he hopes to raise, and growth is going to slow. So now you have the 5-year yield the same level as the 10-year yield, 219. And if the economy is going to slow in response to the now hawkish Powell, well, that could end up being dollar negative.
Book, people talking about this Federal Reserve orchestrating a soft landing. I don't think this Federal Reserve could orchestrate Don Giovanni if Mozart was playing the piano and Enrico Caruso was singing tenor. What am I missing?
Well, yeah, what he laid out, again, is what he hopes to take place. But again, because I talked about the interrelationship between monetary policy, markets, and the economy, it's almost impossible to have a soft landing. It's just a question of how much disturbance will Powell tolerate in terms of how far he gets in these rate hikes. What happens if the S&P 500 is down 25%? Is he still going to go ahead with 7? What happens if in Q2 there's a minus sign in front of GDP, even though inflation is high? Is he still going to do 7 this year? It's what his pain tolerance will dictate how much he's going to be able to get away with this year in terms of hikes. But I think it's almost delusional to think that there's not going to be a notable economic impact and a market impact, since the economy and markets have been so medicated on cheap money for so long.
Peter, thank you. Nice to speak with you. Peter Boockvar, Bleakley Advisory Group. So let's trade today, the day that it was, Karen. What do you make of it? I mean, do you buy this rally? Do you think we're in the all clear? We've got a game plan from Powell, and so we're good.
I bought some things, I sold some things. Actually, for me, it was a pretty busy day. Some of the, I had some spider calls left. I sold those. I think it was a good day, actually, for low PE stocks. I know that seems somewhat counterintuitive because the real high ones ran, but I think that we'll be turning back to more value-oriented ones. So, but on top of all of that, I was confused was probably the most important thing. And then, we'll get to it a little later, but there was some positive housing stuff after the market. I bought some Zillow 1x2 call spreads. I think that was kind of overdone and interesting. So it was a busy day.
The problem with having it all clear is we don't have Putin out of the way. Could have Powell out of the way, but we could get a negative headline tomorrow. So you have to be cautious about the rallies within the marketplace when you have a madman still in Russia. Mm-hmm. So that's the only hesitancy that I have. But raising rates, what does that do for the economy? It's not rhetorical. It's if we're already slowing And if most of this was a supply chain disruption, or if you're thinking about inflation coming in already, doesn't it exacerbate it and put too much on the consumer and on corporations? That's where I'm at.
But
well, how long is this inflation going to? I mean, Steve had alluded to the fact that inflation might come down. We could have a ceasefire tomorrow between Russia and Ukraine, and those sanctions may not come off for a very long time. We don't know what the path here is.
No, I agree. And if you look at oil, it's back to pre-invasion levels. You have commodities that were already well on their way. And this, I know it sounds like the cliche that you don't want to hear, but this was a bear market rally. These were stocks that were way oversold. This was a Federal Reserve rally that I think we kind of diagnosed some of the dynamics leading into this yesterday, which was very oversold conditions. The relief in oil prices and commodity prices, you were limit down in wheat today. You were limit down in a couple other of the softs, and some of the bulks gave some ground. This is very good news for equities, but a 225 10-year is different than a 150 10-year in terms of how you manage your equities. And at some point, a 2% 2-year note is a very attractive place to park cash and as an alternative. So there's some dynamics here that I think are important to pay attention to.
We just heard that, in fact, from Jeffrey Gundlach of Double Line on Overtime previous hour. He would go, it wasn't a would you rather, but basically it was. He said he would rather the 2-year over cash guy.
Well, and you should listen to him when he talks, you know. And he also, I think he echoed, or he didn't echo because he said it before, but, you know, he reinforced some of the things that Peter just said now. You know, he doesn't see any way that they orchestrate us out of this thing. And I agree. Look, today didn't make a lot of sense to me. I know we're going to try to explain it. To me, there's no way to explain it other than this. And we've said this dozens of times. Karen said it last week. The most violent rallies take place in, you know, markets that are headed lower. And I think that's exactly what we saw today.